Hi there. So welcome to the second lesson in our discussion. So in the very first video, we discussed the issue about the various things that you have to understand in relation to how you can study and position yourself to understand everything that you study. So what I want to do, or what we want to look at in this second lesson, is to discuss the commonly examinable areas that we have to look at for the ICAG May 2019 examination when it comes to advanced financial management. So as I mentioned earlier, if you skipped that first lesson on your mental and productivity lecture, make sure you watch that very well, because it is very important for you to understand how you need to study, how you need to position your mind, how the state of mind that you have to be in, so that you can understand or study and understand everything that you study. So this is very important. Now, when it comes to advanced financial management, there are a couple of things that we need to understand about advanced financial management. The first thing that I want to discuss with you is what I refer to as assumptions of fact. Assumption of fact. What does it mean? It means that when we are facing advanced financial management, the three things I'm about to discuss with you are very critical, they are central, and they are pivots to the ICAG Advanced Financial Management paper. The first thing is this. In each examination sitting, there is a question on net present value and cost of capital. This is primary, all right? This is fundamental. So definitely in the exam hall, the examiner is going to ask you some questions on net present value and then cost of capital. It is there. It is constant. The second thing is that in each examination sitting, the examiner is going to ask a question on a new subtopic. Now, when I say on a new subtopic, when it comes to advanced financial management, we have the advanced investment appraisal, we have the business valuation, we have the valuation for acquisition and merger, we have corporate restructuring and reorganization, we have risk assessments now. So what I mean is that in each examination sitting, there is something new, there is a new subtopic under these major topics that the examiner is going to be bringing, and it's something that you need to know about. And then the last assumption of fact is that in each examination sitting, the examiner asks questions, or there will be a question on treasury management and then economic environment for multinational. Okay, treasury management and economic environment for multinational. So these are the three things that you need to understand when it comes to advanced financial management. So before you get into the exam, or before you put yourself in that position to write the paper, you must understand that in the exam hall, NPV is going to be there. In the exam hall, cost of capital is going to be there. In the exam hall, treasury management is going to be there. In the exam hall, there is going to be something on economic environment for multinational companies or multinational businesses. So these are the three things that you need to understand about that. The next thing I want to discuss with you is the key topics that we have to focus on in order to, of key topics that the examiner will be examining on. I've already made reference to a couple of them, but I'm just going to emphasize on that a bit. So the key topics that we'll be expecting. So the first one is advanced investment appraisal. Right? Advanced investment appraisal technique. So the issue about adjusted present value, the concept of free cash flow. Last semester, we expected the examiner to set a question on the adjusted present value and then the concept of free cash flow, and boom, there was a question on that day. So certainly the examiner is going to be bringing a question on advanced investment appraisal. Now, when it comes to the advanced investment appraisal techniques, we have a couple of issues that you need to consider there. So as I mentioned, adjusted present value, APV, the concept about free cash flows in investment appraisal, the issue in relation to the advanced techniques such as modified internal rate of return, and then the issue about duration, and then the issue about discounted payback period. All of these are advanced investment appraisal methods. Then in addition to that also, we need to take into consideration the issue about option theory in investment appraisal. So this is where we use the Black-Scholes module, option pricing module in investment appraisal. Okay, the black shows option pricing module in investment appraisal. So you got to make sure that you focus on these things very well, because certainly there is going to be a question on what investment appraisal. The last semester also, there's something called multinational or international investment appraisal and financing. So last semester the examiner brought a question on that. So it's an area that you have to be on the lookout for. So certainly there's going to be a question on advanced investment appraisal. The second thing, or the next thing there, is acquisition and mergers. Acquisition and mergers. Now this is partly theory and partly calculation. So certainly there is going to be a question on that. Last semester the examiner brought a question on organic growth and those stuff. Now that's the theory area. The calculation area has to do with business valuation. So how do we place a value on a business? You must make sure you understand the principles. You must make sure you understand the concepts. Now I'm not going to be going into detail in a couple of these things, because the next videos following this lecture is going to be full of all the things that you need to know about advanced financial management. Then also you are enrolled in the main or in the full course for advanced financial management. So do not hesitate at all to go into any of the videos, to go into any of the chapters, to watch the lessons. Because if I say I'm going to go through everything, at least this video is going to be like 3 hours or 4 hours long. So business valuation, the various methods of valuing a business, right? So we have the asset valuation method, we have the dividend valuation method, we have the price earnings ratio method, we have the earning yield method. All right. So these are the things that you need to understand when it comes to business valuation. Then you need to understand the issue about pre-acquisition valuation and then post-acquisition valuation. What does it mean? It means, for instance, if company A wants to acquire company B, all right, so we value company A, the acquiring company, company B, the target company. So we have the value that company A can pay to company B for their value. Then what will be the post-acquisition valuation? So right now, if A acquires B and the two companies now become one, what will now be the value of the company? That is what refers to as post-acquisition valuation. So it is very important for us to understand how pre-acquisition valuation is done and how post-acquisition valuation is done. Now when it comes to post-acquisition valuation, there are a couple of things that we need to take into consideration. Number one, in post-acquisition valuation, we are usually going to be using what? The price earnings ratio approach in order to value the combined business, okay? We're going to value the combined business using the price earnings ratio. Now at this level, you know that the price earnings ratio that you're going to be using here is going to be your earnings times what? The PE ratio, okay? Your earnings times the PE ratio. So the earnings here is going to be the combined earnings of A and B, okay? So what is the earnings of A? What is the earnings of B? We combine. So the two combined becomes the total earnings for the two companies. Then we are going to use the industry average of the price earnings ratio. Or if the acquiring company is listed and has its own price earnings ratio, then we're going to be using that to value what? The company post-acquisition. But not only that, because you know that when a company or when two companies merge forces, when one company acquires another company and it becomes a single company, literally as a group of companies, it means that there is going to be what we refer to as synergy effects. Now, what is synergy? Synergy simply, in mathematical form, we represent that as 1 plus 1 is greater than what? 3. Okay, 1 plus 1 greater than 3. So what we say there is that A is bringing in forces, B is bringing its forces. So we are going to be bringing the synergy effects and add it to the value we get here, and that is going to give you what refers to as the post-acquisition valuation. So certainly there is going to be a question on acquisition and mergers, and then business valuation for acquisition. So that is going to be in the exam hall, and you're going to position yourself to make sure that you max out that mark in the exam hall. Then the third thing is business finance, the good old business finance. You know, this is a fundamental area, all right, of the syllabus and of the role of the chief finance officer. Now, Fundamentally, we say that the Chief Finance Officer has 4 roles that he plays, help the company to play. The first one is helping the company in making investment decisions. That is what we discuss under investment appraisal. Helping the company in relation to financing decision. Where do we get the money from and what is the cost of the money? So that financing decision is what we refer to as what? The business finance. So when it comes to business finance, we are looking at sources of finance and then what? Cost of capital. Sources of finance and cost of capital. Now we have short-term sources of finance, we have long-term sources of finance, and we have cost of capital calculation, calculation of cost of equity, calculation of cost of debt, calculation of the weighted average cost of capital. All of these things feed into the concept of business valuation. So the examiner is going to put you on the spot and ask you a question. Now this is partly theory, partly calculation. So the sources of finance, long-term sources of finance, short-term sources of finance, and then the issue about cost of capital. Very, very important. So there is a question in the exam hall waiting for us on that. Then the 4th thing that we can talk about is one of my favorite areas by all standards, that is financial reconstruction and corporate reorganization. Now in a simple language, you got to understand that financial reconstruction simply has to do with the change in the capital structure of the company, right? The change in the capital structure of the company, whilst corporate reorganization has to do with a change in the nature and or operations of the organization. Okay, so financial reconstruction usually would have to do with changing of the capital structure of the company. So with that one, there are methods that we can adopt, such as leverage recapitalization, leverage buyout, debt to equity swap. These are some of the strategies that companies can adopt under financial reconstruction. Then corporate reorganization, we can talk about sell-off, we can talk about cut-out, we can talk about, did I say cut-out? Cut-out, we can talk about something in relation to demergers or divestment. We can talk about the issue in relation to management buyouts, management buy-in. All of these things are some of the things that we need to understand about financial reconstruction and corporate reorganization. So financial reconstruction is going to be the calculation aspect, and then most importantly, something you need to understand is how an organization can accept a financial reconstruction scheme. So what are the factors they have to take into consideration, or what do they do to make a financial reconstruction scheme acceptable? Now, for a financial reconstruction scheme to be acceptable, all stakeholders, all major stakeholders of the entity must be better off under the financial reconstruction scheme. What does it mean? It means that in designing the financial reconstruction scheme and determining which will be acceptable or whether it will be acceptable by all the stakeholders, we will first have to pretend as though the company goes into liquidation. So that's the first approach. So if the company goes into liquidation, we sell off all our assets, how much can we pay to the major providers of finance? The bank, the secured debt holders, the unsecured debt holders, the statutory payment to employees, and then the shareholders. What will everybody's position be when the company goes into liquidation? That is step 1. Then we come to step 2. Step 2 is asking ourselves how much money can be raised under the financial reconstruction scheme. So for instance, if the entity is under the scheme, they are going to be doing some leverage recapitalization, so they are going to be borrowing more, or they are going to be doing some debt to equity swap, or they are going to be subscribing new shares, or they are going to be listing new shares, or they are going to be repurchasing some shares from the management or from the shareholders of the company. At the end of the day, what will be the net cash that will be raised from the reconstruction scheme? That is the second step. Then the third step we go through is to ask ourselves, what would then now be the position of each of the stakeholders under the scheme? That is when the scheme goes through and the scheme is implemented. And then the fourth thing we do is to prepare a statement of income, an income statement extract, and then a statement of financial position. So these are the 4 things we take into consideration in making calculation questions or designing a reconstruction scheme. We need to look at the position of all the stakeholders when the business goes into liquidation, and the position of the stakeholders when the business is refinanced in relation to that. Then also you need to understand what kind of companies can undertake financial reconstruction and financial reorganization. Now, irrespective of the type of the company, each company can undertake it. A solvent company can undertake it, an insolvent company can also undertake it. So that is what you need to understand when we talk about the issue in relation to financial reconstruction and then corporate reorganization. So remember the methods that we discussed about the financial reconstruction and then the methods discussed under corporate reorganization. So these are the key topics that we need to look out for, or we need to focus on to increase our chances in passing the examination. The fifth thing that we are going to be talking about is what I mentioned earlier: treasury management and then economic environment for multinational. Treasury management. You know, one of the decisions of the CFO, in addition to investment decisions, financing decision, dividend decision, is also risk management decisions. Now, when we say risk management decision, what do we mean? You know, companies operate on a global market, right? So companies sell goods outside and they buy goods also from outside. For this reason, companies are exposed to forex currency risk, which is as a result of what we refer to as transaction risk. So for instance, somebody buys, so for instance, we bought goods, right, from a supplier in China, right? Now China, we buy almost everything from there. So we buy some goods from a supplier in China, and we didn't pay the supplier today. We are going to pay the supplier in 3 months' time. Okay. If today the spot rate of the currency, it's say $1 is equal to 5.5321. This is the exchange rate as at the time we are buying the goods. If we don't pay now, and we wait and make the payments in 3 months' time, and the currency jump to 5.8931, what does it mean? It means that we are going to be paying more in relation to that supply. So the question is, how do we prevent ourselves? How do we cushion ourselves? How do we sustain ourselves in order to reduce the impact of this? And that is going to lead us to what we refer to as the hedging techniques. So that is one thing that you need to understand. The examiner is going to put you on the spot there. Now, when it comes to the hedging techniques for transaction risks, there are a number of them that we can mention. We have the forward contracts, we have the money market hedge, we have the currency features, we have the swaps, okay, then we have the options, okay. So the Black-Scholes option pricing module can also be used in hedging of transaction risks. So that is one side of risk management. Then the second side also is about borrowing. You know, every company across the globe borrows money, all right? Because it is very good to use other people's money, OPM, to run your business so that your money can be used for other things. That is the reality. So businesses borrow. But businesses are going to be exposed to what we refer to as interest rate risks. That is a negative movement or an increase in the interest rate risks in the future. So for instance, the company makes a decision today that the next 2 years they are going to start a project or they are going to acquire a company. And in financing that project or acquiring that company, they are going to do that through debt finance. Now, if they don't borrow the money today and they wait till 2 years to go and borrow the money, it is likely that the interest rate of the banks will what? Go up. That kind of situation is what refers to as the interest rate risk. So the question we need to ask ourselves is, how can the company cushion itself, prevent itself against that future increment in the interest rate? That is what refers to as hedging of interest rate risk. So we have to find out how we can hedge ourselves. Now, so under that one also, there are a number of methods. We can use forward rate arrangement, okay, forward interest rate arrangement. We can use currency features. We can use swaps. You see, the idea about swaps works this way. For instance, let's say we're going to be buying a company in China, and we are going to be paying in dollars, all right? Then a company in China may also want to undertake a project here in Ghana. Now, they need some Ghana cedis, we need some dollars to make, or some yen to make the transaction. So this is what how swaps work. The company in China who happens to be our partner will borrow the money there. So they will borrow the yen there, at an interest rate, then we, because we are in Ghana here, we will also borrow an equivalent of the amount in Ghana cedis. So we need some yen, they need some Ghana cedis. Then we now exchange the currency. So they don't need the yen, we need the yen. We don't need the Ghana cedi, they need the Ghana cedi. So what do? We swap. So that is what refers to as currency swap, and it's also one of the ways through which companies can hedge themselves against what refers to as interest rate risk. Then another thing about swap is about goods. So let's say, for instance, I'm in Accra, and let's say you are in Kumasi. What is cheap in Kumasi? I've heard that meat is cheap in Kumasi. I guess meat is cheap in Kumasi. So let's say I need meat. And then what is cheap in Accra? Maybe fish is cheap in Accra. Maybe let's say tilapia is cheap in Accra. So what is happening is that you have meat in abundance. I have fish in abundance. Okay. Now when I come there to come and buy the meat, it's going to be expensive. When you come here to come and buy the fish on your own, it's going to be expensive. So what do? I am going to buy the fish on your behalf. Then you are going to buy the meat on my behalf. Then at the end of the day, what do? We swap it up. Okay? Then we settle the difference between us. That is what refers to as goods swap. So currency swap or goods swap is also one of the ways through which an organization can hedge itself against foreign exchange risks. Then certainly the last thing is about economic environment for multinationals. Economic environment for multinationals. So when it comes to multinationals and their economic environment, how they raise money, how their governance is done, how they are faced with a lot of government decisions. So for instance, if a company is operating here in Ghana, the government can say that you don't expatriate any money, you don't take any money out of the country. If you try to take money out of the country, you pay a withholding tax of 60%. Now, that would discourage a lot of multinational companies, but there is also a way through which, when that policy is put in place, the multinational company can still get its money out. Okay, there are various ways, and I discussed that one in detail as well in relation to international investment appraisal. Some of the things that they can do is to charge what we refer to as management fees. So if, for instance, the investor is in the UK, then the Ghana government says that, okay, any investor that expatriates, takes out any money, we will charge them withholding tax of 60%. You know that is very high, right? So if they are taking $100,000 out, it means the government will take $60,000. So they are going to take only $40,000 out. So that will discourage them. But they will now pass through the back door to still take their money. So they will charge management fee. What does it mean? It means that instead of taking this $100,000 every year, they will coin it into a management fee to charge the subsidiary here in Ghana. So that the subsidiary will write that $100,000 in as part of their expenses for the year as fees that they are paying. So that the money will be transferred, but this time around it is not about what? Taking of their profit, is about the service that they are rendering. And that is one way that they can take their money out. Another way also is to use what we call transfer pricing. What is transfer pricing? So if they sell some goods to us here in Ghana, what they will do is that if the price of the goods is, say, $10 per unit, they may decide to charge $20 per unit, so that we will pay them more money when buying the goods. So indirectly, they are taking the money out. So that is also one way that companies or multinational companies deal with government policies that prevents them from expatriating funds into their home country currency. So when we talk about advanced financial management, these are the key areas that we need to open ourselves up, that the examiner is going to be setting questions on. But a big question we need to ask ourselves is, all right, so for May 2019, what are the areas that we have to focus on for the ICA and relation to the advanced financial management? What areas must we focus on? So I'm going to cover that in the next lesson, and you make sure that you stay tuned.